So, what's the story with the market right now? Well, it's this absolutely fascinating tug of war. On one side of the rope, you've got these incredible earnings from the world's biggest tech companies, painting this picture of real strength. But on the other side, the global economic landscape is pulling in the complete opposite direction. So today, we're going to break down who's pulling the hardest.
Here's how we're going to untangle all of this. First, we'll dive into the explosive earnings from big tech. Then, we'll zoom out to see the huge divide between central banks and how that's causing ripples in the currency markets. After that, we'll take the market's temperature with some key data before looking ahead to what's on the horizon this week. All right, let's kick things off with the micro story. Those after-hours earnings reports from a couple of tech titans, they sent a real jolt of electricity through the market. But as we're about to see, not everyone is riding that same AI wave. It's really become a story of who's in and who's out.
And this quote right here, it just nails the shift in mood we saw. After things felt a little shaky earlier in the week, these blockbuster results from Apple and Amazon just completely flipped the script. According to various news commentary, it really reignited this hope that the massive AI-driven rally we've all been watching still has some gas left in the tank. And wow, did the market react. We're not talking about a tiny little bump here. NASDAQ 100 futures shot up over 1% in after-hours trading. That was a really powerful vote of confidence, and it was pretty much driven by just a couple of key players. But this is where the plot really thickens. On the left, we have the heroes of the moment. Apple is talking about double-digit growth for the iPhone, and Amazon's cloud business just posted its fastest growth in years. Awesome, right? But on the right, it's a totally different story for Meta. Their shares plunged because they signaled this massive spending on AI without a clear path to making that money back anytime soon. So here's the crucial takeaway. The days of just slapping an AI label on something and getting a blank check from investors, well, those days are over. People are getting a lot smarter, a lot more selective. They don't just want to see companies spending money. They want to see a real, credible strategy for turning those huge investments into actual profit. That discernment is really the main theme this earnings season. Okay, so let's zoom out from all these individual companies and look at the global economy. Because right now, the biggest source of tension, the thing pulling everything in different directions, is the diverging paths of the world's major central banks. We're talking about something called monetary policy divergence. It sounds kind of technical, but the idea is simple. It's what happens when the big players, the Fed in the US, the ECB in Europe, the Bank of Japan, all stop singing from the same hymn sheet. One might be hiking rates to fight inflation, while another is holding steady or even cutting. This creates these powerful and sometimes unpredictable currents in the global financial system. And what's happening right now is a perfect example. The US Fed recently cut rates, but they sounded really hawkish or aggressive about it, basically warning that more cuts are not a sure thing. Meanwhile, the European Central Bank is just holding steady, taking a more neutral wait-and-see approach. And then you've got the dovish, or more passive, Bank of Japan, keeping rates near zero with no real signal on when they might finally raise them. 3 major economies, 3 totally different game plans. Okay, so what does all this central bank talk actually do in the real world? Well, we're about to see its most dramatic effect, which is almost always in the currency markets. Let's really hone in on the story of the US dollar versus the Japanese yen. And this brings us to a huge question that a lot of traders are wrestling with. Why is the yen so weak against the dollar right now? I mean, it's hitting lows we haven't seen in months. The answer, not surprisingly, ties directly back to that policy divergence we were just talking about. And here's what that looks like. This chart just lays it all out, plain and simple. On one side, you have the US dollar staying strong because the Fed is keeping interest rates relatively high. On the other side, the Japanese yen is weak because the Bank of Japan is sticking to its guns with that ultra-low rate policy. That gap between them just keeps getting wider. And you know who's paying attention? The big money. As seen in the provided information, hedge funds are placing some major bets that this trend is going to continue. They are actively positioning for the yen to fall even further, maybe even hitting that 160 level against the dollar by the end of the year. So this isn't just idle chatter, it's a major trade built on these fundamental policy differences. The mechanics behind this are actually pretty straightforward. Global money flows to where it can get the best return. So higher interest rates in the US act like a giant magnet for investment, which boosts demand for dollars and makes it stronger. Japan's super low rates do the exact opposite, weakening the yen. Simple as that. Okay, so we've got these 2 clashing stories, right?
There's the sunny, optimistic story from big tech, and then there's the cloudy, uncertain macro story from the central banks. So now let's try to figure out which story is winning by looking at some broader data to get a feel for the market's real mood.
A great way to do this is with the CME FedWatch tool. It basically gives us a direct look into what the market is thinking. It analyzes futures prices to figure out the odds of what the Fed will do next. And as we can see, traders are overwhelmingly betting, like 85%, that the Fed is going to hold rates steady at its next meeting, which totally reflects that hawkish message we heard. But this slide right here tells the real story under the surface. While those big tech names were sending NASDAQ futures soaring, the rest of the market was telling a very different story. Based on the input sources, a whopping 61% of stocks were actually declining. This is our tug of war in a single chart. A few giant companies are pulling the market up, while the vast majority of stocks are getting dragged down. Okay, let's wrap this up by looking forward. This ongoing battle between micro-optimism and macro-gloom is going to be decided by the economic data that's coming out. So what are the key events we all need to be watching in the next few days?
And boy, is the calendar packed. Today, on October 31st, we get the core PCE price index. This is the Fed's absolute favorite way to measure inflation, so it's a huge deal. We also get the Chicago PMI, which gives us a read on manufacturing health, plus major earnings from the energy giants. And looking into next week, the earnings parade just keeps on going, with AMD, McDonald's, and Pfizer.
Now, why do these matter so much? Because every single one of these data points is a new piece of the puzzle. Strong inflation data could force the Fed to stay aggressive, while weak earnings could really test that optimism in the tech sector. Following along on a financial calendar like the one on investing.com is a great way to keep track of all this in real time. And that brings us right back to where we started, with this final critical question. We have two incredibly powerful opposing forces at play. The relentless innovation and optimism of big tech clashing with the heavy weight of global economic uncertainty. So which side is going to win this market tug of war? That is the question that will define the next chapter for all of us. Thanks for watching. Don't forget to like and subscribe.